Hi, good afternoon, everyone. Welcome and thank you for attending today's long-term care hearing. I am the Chief Actuary of the Maryland Insurance Administration, Brad Bowman. And this is the Maryland Administration's third quarterly public hearing in 2023 on long-term care rate filing increases. Unfortunately, Commissioner Borain could not attend today's hearing, so I apologize, but I will be leading in her place. Today's hearing is going to focus on rate requests from 4 companies in the individual long-term care market. These include requests from Allianz Life Insurance Company of North America, who are proposing an average increase of 18% for insureds under policy form 11-P-Q-MD. Continental General Insurance Company is proposing an increase of 295% for all insureds under policy form 2 LTCI P0001. They're proposing a 120% increase for all insureds under policy 4 LTCI P0001. They are proposing 300% for all insureds under policy form 1 LTC IP001 and policy form 1 LTC IP002. They are proposing an average increase of 288% for insureds under policy form 80650 space 1-97 space MD and the policy form 80880 NTQ 198 MD. And finally, they are proposing an average increase of 277% for insureds under policy forms 8200 1-01 MD and 82120 9-01. Transamerica Life Insurance Company is proposing an increase of 23.12% for all insureds under policy form ICC 10 space TLC-3. And finally, Unum Life Insurance Company of America is proposing an increase of averaging 48% for insureds under policy forms NH5092, LTC5092, LTC94, LTC94Q, LTC99, and LTC99Q. In addition to those increases, which were all in the individual long-term care market, we are also discussing increases in the long-term in the group long-term care market. These group increases requests are from Unum Life Insurance Company of America, and they are proposing an average increase of 74.4% for insureds under policy form B-B.LTC or TQB.LTC or GLTC95 or TQGLTC95. And then they are also separately requesting an average of 16.5% for insureds under policy forms GLTC04 and RGLTC04. These requests in aggregate across the individual and group long-term care markets impact approximately 15,362 Maryland policyholders. The purpose of this rate hearing is for the insurance company representatives to explain the reasons and drivers of their rate increase requests, and for the MIA to consider whether the proposed rate increase is in compliance with Maryland laws and regulations related to long-term care insurance. We will also listen to comments from consumers and other interested parties. We're here to listen and ask questions of the carriers and consumers regarding the specific rate increase requests. I'd like to take a moment to introduce my colleague who is here with me, Adam Zimmerman. He is a senior actuary in the office of the chief actuary, who has a lot of long-term care experience. I'd also like to go over the procedures we're going to follow today. When it is time for public comments, we will call first on any member of the public who registered to speak in advance. And then after that, any unregistered participants who have accessed the Zoom webinar platform are allowed to speak if they desire. If you want to speak and you're on the webinar, please communicate via the chat function, and you can be made a panelist and be given an opportunity to speak. With the exception of the MIA staff, this hearing is not a question and answer forum. Comments from interested parties have been received and reviewed in advance of the meeting. We will keep the record open until Tuesday, September 5th, for any additional written testimony. A video of today's meeting, as well as all written testimony submitted, will be posted on the MIA's website on the long-term care page. The long-term care page can be found on the MIA's website by clicking on the Consumers tab on the top of the homepage, and then clicking the long-term care link. And as a reminder, all of the filings that we were discussing today have already been posted on that website. And so if you did not catch whether your form number was listed in what I read off, you can go and check on the website, and all the form numbers and the filings that we were discussing today are already on that website. To help ensure excellent sound quality throughout the hearing, we ask anyone who is not speaking to please stay on mute. Also, anytime you're speaking, if you could please state your name and organization when you start speaking, that would be of a great help. Thank you. We're going to be asking the carriers to speak first regarding all of the rate increases. Carriers will be called in A to Z alphabetical order. Afterwards, any interested stakeholders will be allowed to speak. Before I turn it over to the carriers, I would just like to make a few high-level statements about the long-term care rate review. You know, the numbers that I read off when I was going over the requested increases are pretty high. Some of them, in the hundreds of percents. And the MIA understands how large these increases are and how difficult these types of increases are for consumers. As a context, the long-term care industry as a whole, what was mispriced when it was launched back in the 80s and 90s. This is across all insurance carriers, across all 50 states in the United States. The assumptions that were used back then underestimated the level of claims that would ultimately occur. In general, there are certain types of assumptions that the carriers may go through that are common to the entire industry. Long-term care, but by its nature, has high premiums and low claims in early years, and those premiums must be set aside for the high claims in later years, where there are relatively low premiums. And so, as I said, carriers have underestimated premiums claims for a variety of reasons. The two big reasons are lapse and mortality assumptions. They assumed that before people would ever go on claim, they would either voluntarily lapse their policy or die before they utilize these claims. And those percentages both turned out to be too high. There have been less deaths and less lapses than anticipated, and that means there are more people around to go on claims. And carriers have also underestimated the morbidity of the claims. The average length of utilization is longer than first anticipated. In many cases, the average cost per day is also higher. And then compounding all of this is investment rates that have come in lower than anticipated, and that hits the premium side. Those premiums in early years are set aside, and when they originally priced these, they assumed high single-digit investment returns, which was commensurate with the history back then. But then throughout the 2000s up until a year or two ago, investment returns were very low, much lower than historic averages. And so, the premium has not grown as much as expected. And so that compounds the problem and makes it even worse. Here at the MIA, we are tasked with making sure that rates are neither excessive nor inadequate nor discriminatory. And as far as where that plays into with these long-term care filings, a lot of these long-term care products have loss ratios that are in excess of 100%. And that means, more dollars are going to be paid out of claims than are collected in premium. A loss ratio of 120% means that for every dollar of premium collected, the company will have to pay out $1.20 in claims. And so that is obviously inadequate. And in that scenario, a company would need to dip into its surplus and would worsen their financial condition. In general, most of the loss ratios that we approve when we review long-term care filings are in the 80 to 120% range. At 80%, carriers are almost breaking even. Sometimes maybe are earning 1 or 2% profit. When these plans were originally priced back originally, the target loss ratios tended to be in the 60 to 65% range, with carriers targeting, double-digit profits. And so that's the greater context for where these products started and how we got into this situation. And so with that, I'm going to turn it over to the carriers to discuss the specifics of their policies. Each set of policies has their own considerations. So with that being said, the first carrier is Allianz Life Insurance Company of North America. I have that Mr. Scott Laska was supposed to be the representative. So Mr. Laska, if you could please speak for address the filings that you've submitted.
Hi, yeah, just check. Can you hear me all right?
It's a little hard to hear you. If you could turn the volume up somehow.
Yeah, I'll do my best. All right. Yeah, hello. My name is Scott Laska, and I'm a long-term care actuary at Allianz Life Insurance Company of North America, and I'm in good standing with the Society of Actuaries and the American Academy of Actuaries. I'm joined on this call by David Kumatz, counsel to Allianz Life. Thank you to the Maryland Insurance Administration for reviewing our filing and having this hearing today to give us the opportunity to discuss the considerations that went into our request. We understand rate increases are difficult for our policyholders, along with insurance departments who are trying to balance the impact on their constituents with maintaining a strong private market for long-term care needs. We are requesting a rate increase on our Generation Protector 2 and Generation Protector Select policy forms under policy form number 11-P-Q-MD. These products were sold in Maryland from 2006 to 2010. This rate filing would impact around 292 of our 1,523 Maryland policyholders. We are currently requesting an average rate increase of 18%. The level of the rate revision varies by the policy's benefit period. This rate increase is a follow-up to the most recent rate filing approved on October 14th, 2021, where the rate increase level approved was less than the nationwide average request from the 2021 effort. The current rate increase proposal is comprised of the remainder of the 2021 request for each benefit period that was not approved, and is consistent with the approach taken in jurisdictions which approved less than the 2021 requests. These forms are in need of additional premium rate increase due to past and projected future experience that continues to be more adverse than previously expected and originally priced for. The current premiums are unreasonably low in comparison to the benefits provided. A rate increase on these policy forms is needed to reduce losses on the business. In the interest of balancing the needs of policyholders and rate equity across jurisdictions, we are requesting premium rate increases averaging 18%, which is much lower than we could actuarially justify. By lowering the requested increase from what is justified, we anticipate sharing in the losses of this business. We understand that this request is greater than the required annual cap of 15% in Maryland. We would like the opportunity to work with the MIA to phase in the rate increase over multiple years at no more than 15% per year, so we can be more transparent with our policyholders regarding our increased plans. The full requested rate increase is approved and implemented. The company currently does not intend to request any additional rate increases on these policy forms unless experience worsens. We will guarantee not to increase the revised rates for 4 years. If the requested premium revision is granted, the total rate increases approved in Maryland would be in line with the total rate increases approved on these policy forms nationwide. The premium levels after the requested increase on these policy forms would still be lower than the premiums of long-term care policies sold in the market today. It is important we offer and communicate to policyholders multiple options to reduce the impact of the rate increase if they are unable or unwilling to pay the higher premiums. Among their options, policyholders can reduce their benefit period or benefit amounts, cancel their benefit increase rider, or lengthen their elimination period. We communicate these options in several places in our rate increase mailings and encourage policyholders to call our dedicated contact center to better understand their options. Our contact center has access to various resources to illustrate policyholder premiums and benefits under different coverage scenarios, along with access to a cost of care website. The cost of care website provides average LTC costs across the country, so policyholders can make more informed decisions about how much coverage they'll need. I encourage any affected policyholders to access the cost of care website and to call our contact center for any assistance with understanding the options that are available. We are offering additional benefits to our policyholders as part of this increase as well. Those who choose to reduce or cancel their benefit increase riders will maintain all of their past accrued benefit increases to date. Additionally, we are offering a free paid up benefit for policyholders who decide to stop paying premium because of the rate increase. Rather than losing their entire coverage, policyholders who stop paying premium as part of the rate increase will get a reduced paid up benefit, typically equal to the premiums that have been paid into the policy. As we consider the impact a requested increase would have on our policyholders, we wanted to know that policyholders would still find value in their insurance after the requested increase. In addition to premiums being lower than long-term care policies sold in the market today, we looked at policyholder behavior around our recent rate increase implementations. In our experience, the vast majority of policyholders impacted by a rate increase have decided to maintain their current benefits and pay the increased premium, which is in line with experience across the industry. Nationwide, we have seen around 12% of policyholders elect to reduce benefits on recent rate increases, and less than 3% decide to stop paying premium altogether. This indicates to us that policyholders still see value in their Allianz long-term care insurance to cover future long-term care needs that can be very costly and deplete retirement savings quickly. Once again, I'd like to thank Maryland Insurance Administration for giving us the opportunity to discuss the considerations that went into our rate increase request. We look forward to working with you on finding a solution that balances the needs of all stakeholders. We'll take any questions that you may have.
Thank you very much. I have one question. So the average rate increase is 18%, but that varies, right? Does it vary by just benefit period or also by benefit period and inflation rider? And can you discuss the variation in the increase?
Yep, so the variation is just by benefit period. And I can give a little bit more background too. As I mentioned, this is a follow-up request to an increase that we initially filed for in 2021. And that filing too just varied by benefit period. So we grouped it by those with a 2 to 4 year benefit period, a 5 to 8 year benefit period, and then a lifetime benefit period. They all initially got a different request. The 2 to 4 year cohort initially in 2021 got a 15% request. The 5 to 8 year cohort got a 25% request. And the lifetime cohort initially got a 45% request. And we received approval in 2021 equal to 0% on the 2 to 4 year cohort, 10% on the 5 to 8 year cohort, and 15% on the lifetime grouping. And so our request now is just the difference between what we had initially requested and approved. So it's 15% for both the 2 to 4 year cohort and 5 to 8 year cohorts, and a 30% increase on the lifetime benefit period policyholders.
All right, thank you for that clarification. I think that's the only question I had. Adam, did you have any questions?
I'm okay for now. Thanks, Brad.
All right, thanks very much for your testimony, Mr. Laska. Next, we're gonna go to Continental General Insurance Company. I have that Mr. Pyle and Ms. I'm gonna slaughter your last name, Narup.
Narup, yeah.
Narup. And so I'll leave it up to you on who would like to speak. But I will turn the testimony over to you now.
Thank you. Hello, my name is Madison Narup. I'm the Assistant Vice President of Pricing at Continental General Insurance Company. We also have Tom Pyle joining us, who is the Chief Actuary at Continental General Insurance Company. I'm an associate of the Society of Actuaries and a member in good standing with the American Academy of Actuaries. First off, I want to thank you, Brad, Adam, and the Maryland Insurance Administration for the opportunity to discuss Continental's rate increase request. Continental General Insurance Company is a privately owned company with a single owner who receives no dividends from the company. The company has a significant concentration on LTC on long-term care liabilities. Therefore, due to the importance of long-term care for this company, we conduct experience studies every other year and review our assumptions each year. This allows us to reflect current mortality, morbidity, and lapses in our rate increase projections. Currently, the company has 5 rate increase requests that affect 8 policy forms. These policy forms are 1 LTCI, 1 LTCI P002, 2 LTCI P001, 4 LTCI P001, 8650, 800 or 80880, 82000, and 82120. These 8 policy forms were issued in Maryland between 1999 and 2009, where since 1999, Continental has paid Maryland policyholders $13 million in claims and incurred $22 million. These 5 rate increase requests the company has filed affect around 300 Maryland policyholders, half concentrated in the 80650 and 80880 policy forms. In addition to pursuing rate increases for these blocks of business, the company is piloting wellness initiatives to improve policyholders' independence and lower the future claim costs. Additionally, the company understands that the rate increase requests are high, but we believe that these are the target premiums that are appropriate for the benefits provided by the policies and where the premium should ultimately be. These rate increases are necessary at this time due to higher than anticipated lifetime loss ratios, which are a result from a combination of lower deaths and increased claim cost. The company rate increase requests for these 8 blocks are for 1 LTCI, 300% implemented in 10 phases of 15% or less, which affects 49 policyholders. 2 LTCI, which is 295% implemented in 10 phases or less, or 10 phases of 15% or less, which is 19 policyholders. 4 LTCI, 120% implemented in 6 phases of 15% or less, which affects 35 policyholders. These 3 policy forms had 2 prior rate increases with a cumulative approval of 32.25%. The other forms, 80650, 80880, 8200, and 82120 are split by inflation option. For 8650 and 80880, the policies with compound inflation were requesting 300% implemented in 10 phases of 15% or less, affecting 134 policy holders. No inflation were requesting 200% implemented in 8 phases of 15% or less, which affects 14 policy holders. And then for our last policy forms, 82000 and 82120, for policies with compound inflation, we're requesting 300% implemented in 10 phases of 15% or less. That affects 31 policyholders. Policyholders with simple inflation, we're requesting 250% implemented in 9 phases of 15% or less. That affects 2 policyholders in Maryland. And then policies with no inflation, we're requesting 149% implemented in 7 phases of 15% or less. And that affects 8 Maryland policyholders. These rate increases, these policyholders have had 3 prior rate increases with a cumulative approval of 75%. As I mentioned earlier, these premium rate increases can be very difficult on policyholders. Therefore, in our policy notifications, we lay out the different reduced benefit options to elect. And we allow all policies to choose a contingent not forfeiture option, regardless of the cumulative rate increase amount or the rate stability status. In our policyholder notification, we also give our customer service number and encourage the policyholders to contact the company to help change their benefits to a combination that matches their health and financial needs. I want to again thank you all for allowing us the opportunity to discuss our rate inquiry request. And if you guys have any questions, me and Tom are willing to answer those.
Thank you very much. I have one question. With respect to benefit buy downs, for those with inflation riders, if they drop their inflation rider, will they keep the accumulated value and just lose the compounding going forward, or will they lose the whole compounded value?
They have both options. They can either take and keep their DBA that they have accumulated over time, or they're welcome to drop back to their original DBA and have it priced on that. So they will have both options when it comes to people dropping the inflation.
So there will be a different premium impact on those 2 options, and they will be communicated clearly to the policyholder, the implications.
Yes, correct. We have our policy. We've recently redone our policyholder letter in accordance to the RBO guidance that I put out. It's like a 58 point that NAIC put out to make sure that we're communicating clearly to our policyholders their options. And this will be communicated clearly with that we have it very distinct of what the 2 options are of keeping the current DBA. Therefore, yes, their premiums would be higher since it's calculating off that DBA, but it will be using a premium of a no inflation policyholder. And then the other option is original DBA and apply that.
All right, thank you.
Mm-hmm.
And then can you confirm that these increases, you would not anticipate filing any future increases unless experience worsens significantly?
Yeah, so we don't, if we get what we have requested, we plan on not filing until the 10% mildly adverse experience deterioration in our experience is seeing.
All right, thank you. And then just to make sure I heard you correctly, you said the non-forfeiture option would be provided to all policyholders, regardless of if there is any requirement or not for them to actually be given it, correct?
That is correct. Yes, all policyholders will be able to elect that.
All right, and that is also part of that sample policyholder letter.
That is correct. Yes, we lay those all out.
All right, and that should be in SURF, right? I think that's something that they usually include in SURF.
Yeah, we have our, that's usually included, and that should be in our SURF, our rate increase notification that's been submitted.
All right, thanks very much.
Of course.
Adam, did you have any questions?
I'm okay, Brad. Thank you.
All right. In that case, thank you very much. Appreciate the testimony. Next, we're going to go to Transamerica Life Insurance Company. For Transamerica, we have signed up. We have Brad Rokosh and Matt Alman. And so I'll turn it over to you guys and whoever wants to take the lead. Please go ahead and start.
Fantastic. Thanks very much for the opportunity to be here on behalf of Transamerica. My name is Matt Alman. I'm Senior Director of State Government and Policy Affairs at Transamerica. I'm here with Brad Rokosh, Head of Financial Assets Health Team at Transamerica. Our filing consists of one Uniproduct 2B policy form written by Transamerica Life. The rate increases would affect approximately 321 policyholders with annual premium of around $487,000 a year. These policies were issued from 2012 to 2016. We are seeking an increase of 23.12% on this policy form. Given the statutory cap, we would expect to spread this increase over 2 years. Reasons why Mr. Bowman and other companies have expressed some of these same factors. Key pricing assumptions have deviated from the original expectations. More policyholders keep their policies longer than anticipated. Certainly, they value the coverage, but it leads to significantly more claims than anticipated. When you couple that with the increasing costs of long-term care services, people living longer, people staying on claim longer than expected, it's all leading to increased overall costs. We believe that we have a responsibility to manage this business by monitoring this experience, to support the development of future assumptions and expectations, which will ultimately support actuarially justified rate increases. In addition, we are committed to providing our policyholders with alternatives to rate increases where possible. We understand the value of these policies and the inconvenience and potential challenges of these rate increases. So we offer a slate of potential benefit reduction options or benefit changes. Policyholders can choose to reduce or offset a rate increase by picking some of those options. In addition to traditional downgrade options, we also provide a contingent non-forfeiture benefit. Plus, we are introducing a cost-sharing option. Let me thank you again for inviting us to participate in the hearing, as we greatly appreciate the opportunity. And Brad and I stand ready to answer any questions.
Thank you very much. One question I have, so this is an interstate compact filing, and I was wondering if you could just briefly describe what the interstate compact is and why you're bringing the filing to us.
Brett, do you want to take that? I can certainly do the first part, but you'd have to do the second anyway.
Sure, you want to take the first part?
Sure, and stop me or just kind of wave when you've heard enough. But the interstate compact is an agreement by states. I think it's 45 plus states now that allow you to file your products with the compact for review and approval, as opposed to filing in those individual states, as you still have the option to do and was done historically. That way, when you get approval by the compact, you have approval by all of the participating jurisdictions, unless they've opted out of the particular standard in question, whether it's DI, long-term care, one of the life standards, et cetera. Brad, I think I'll kick it to you for the second.
Yeah, so Brad Rokosh. So we filed, as Matt said, our original product with ICC. So when we do a rate increase filing, we also file with the interstate compact. They review it. They determine if it's a justified rate increases per their regulations. If the request is higher than 15%, which in this case it was 23.12%, they issue an advisory memo, which is a recommendation from the interstate compact that this policy form would need a rate increase above 15% or the 23.12%. And at that time, once we get that advisory memo, it is up to Transamerica to then file with every state that was participating in the long-term care, participating or was with the original filing at that time, and Maryland was one of them. So we are actually filing with Maryland to get the rate increase approved of 23.12%. So, and it is up to the state then to determine if they will grant that rate increase per their regulations in filings. So
Thanks very much for that background. And I just wanted to bring it up since, you know, it's relatively unique, and you know, Maryland is a member of the compact for long-term care filings. And you know, as you said, the authority is still and are ultimately with the MIA as to whether to approve this. So we have received the advisory report for this filing. We are taking it into consideration. But we are also going to do our normal rate review, and the decision will ultimately be made consistently with how we normally make decisions. So I just wanted to give that background, and thank you for helping me on that. I had another question about one of your reduced benefit options. You mentioned a cost sharing option. Could you describe how that works in a little bit more detail, please?
Sure. So cost sharing is similar to co-insurance. So at the time of the benefit rate increase, policyholder could elect cost sharing. It offsets the full rate increase. Let's use an example of a person has $200 per day, and the co-insurance or cost sharing percentage is 10%. We would reduce those policyholders to $180 daily benefit amount. By the time of claim, they would participate in the claim, similar to other health insurance. So if an individual had a $100 home health care claim, we would apply the co-insurance factor to that amount. We would reimburse them at $90, and then the policyholder would be subject to that $10 out-of-pocket expense. If the expense was higher than their daily amount, that's been reduced at $180. Say that's $200 or say $300. $200 at 10%, it'd be reduced down to $180 for the reimbursement amount. They'd be capped at the $180, but reimbursed that full amount. So it's actually a way to mitigate the costs mitigate the rate increase, plus for policyholders to share, or kind of for us to share those expenses when at time of claim. So it's similar to most medical co-insurance factors that you would have with major med, etc., or Medicaid or Medicare, sorry. Hopefully that explained it enough, Brad.
Yeah, I think so. So I mean, I think the key point there is that, you know, the policyholder is going to be sharing in the cost, even if they are below their daily benefit max. You know, if it is a 10% cost sharing, that they're always going to have 10% of that daily cost to pay. But that is a trade-off for a lower premium. All right. Thank you for that clarification. And I'm not sure if you said it, but can you confirm this is the first increase filed for this policy form, that you've not gotten previous increases approved with the interstate compact?
Yes, it's the first rate increase for this policy form. No other rate increases have been filed or approved by the compact.
All right. I don't think I have any further questions. Adam, did you have any questions?
No, I'm okay. I was going to ask about the cost sharing, but that's been addressed. So thank you.
All right, thank you.
Thank you.
Thank you very much. And then finally, for the carriers, we have Unum Life Insurance Company. I have that Mr. Jake Lucas and John Lemoyne have signed up to speak. You have both individual filings and group filings, but feel free to discuss them all at once, and I will hold my questions until the end.
Great, very much. Thank you very much. First, let me just start out by expressing our appreciation for Commissioner Borrain, Mr. Bowman, Mr. Zimmerman, and the other members of the staff of the Maryland Insurance Administration for the opportunity to participate in this hearing. We appreciate the ability to be able to do that. My name is John Lemoyne. I am the Assistant Vice President and Legal Counsel for Unum's Closed Block Business Operations Unit. Unum's Closed Block Business Operations Unit is comprised of products that Unum no longer markets, including our long-term care business. With me on the call today is Jake Lucas, who is Unum's Chief Long-Term Care Pricing Actuary and who is also in our Closed Block Business Unit team. Perhaps a bit of history would help provide some context for our comments today. Unum began selling long-term care insurance in Maryland in 1989, consistent with when we began selling on a nationwide basis. We exited the individual long-term care market in 2009 and exited the group long-term care market in 2012. We currently have over 3,200 Maryland individual long-term care policyholders and nearly 12,000 insureds who are covered under group long-term care policies issued to Maryland employers. Nationwide, our companies provide LTC protection to over 900,000 insureds. So we at Unum take our commitment to our LTC policyholders very seriously. A top priority of ours is to meet our obligations to each of our customers, including providing benefits in their time of need. And as an example, in 2022, we paid over $15 million in long-term care benefits to Maryland insureds and approximately $760 million in long-term care benefits nationwide. We recognize that our policies provide valuable protection and peace of mind to our insureds, and that rate increases can be difficult for our policyholders. So we welcome the opportunity to discuss our rate increase requests, to explain why they are needed, and to identify options for our policyholders to mitigate the impacts of those increases. The pending rate increase requests under discussion today focus on our block of individual Maryland policies sold by Unum Life Insurance Company of America between 1993 and 2003, and on our block of Maryland group policies, which were sold between 1992 and 2012. The total number of Maryland insureds who would be impacted by our requested premium increase on our individual policies is approximately 2,800 policyholders. The total number of group insureds who would be impacted by our requested premium increase on our group policies would be approximately 3,000 insureds. Our rate increase filing materials support the requested increase and reflect the full amount of the increase we are seeking. However, we understand that the Maryland Insurance Administration generally limits rate increases to a maximum of 15% per year, and we are willing to work with the administration to phase these requested increases in on an actuarially equivalent basis over multiple years at no more than 15% per year. Another priority of ours is to manage all of our insurance products to ensure the financial stability of our operating companies, both for the short-term horizon and for long-term sustainability. This is extremely important, not only for our LTC policyholders who rely on us, but for all of our policyholders. These requested rate increases are necessary because, like many in the industry, our actual experience in the years and even decades since we issued these LTC policies has turned out to be significantly different than the actuarial assumptions used to set original prices. These developments include individuals covered under long-term care policies are living longer and holding on to their coverage longer than anticipated, leading to more claims being made than had been originally projected. Also, once individuals are on claim, they are staying on claim longer than anticipated. As a result, our LTC block of business has suffered significant overall losses. As part of our responsible management of this business, we continually monitor and analyze our experience on our LTC policies. These requested rate increases reflect the results of our most recent actuarial analysis of our actual and projected experience and include amounts remaining outstanding from prior rate increase requests that were limited by the annual rate increase caps applied by the Maryland Insurance Administration. We also should note that we will continue to monitor and evaluate the experience on our LTC business over time, as we are charged to do under regulatory and actuarial standards. If experience develops adversely to our most recent projections, we may need to return to Maryland in the future with additional rate increase requests. Recognizing that LTC rate increases may present significant challenges to our customers in maintaining their coverage, we offer our policyholders options to adjust various coverage features on a go-forward basis to reduce the level of their premium, either in response to a rate increase or to manage affordability generally. Depending on the provisions of the policy itself, these adjustments may include reducing the monthly benefit amount, reducing benefit duration, changing or dropping inflation coverage if the coverage includes inflation, or increasing the elimination period. Also, in conjunction with Unum's LTC rate increases, we provide each of our impacted policyholders with a non-forfeiture option where the policyholder can choose to no longer pay premiums going forward, but nevertheless retain coverage with a benefit amount equal to the total premiums paid by the policyholder on that policy. Our rate increase request filings also include proposed customer communication materials, which identify and explain these options in greater detail. These materials also include a toll-free phone number so that insureds can call to speak with one of our dedicated team of LTC customer service specialists for additional assistance. We at Unum believe that no policyholder should surrender coverage as the result of a rate increase, and we believe that these mitigation options offer reasonable alternatives to our insureds at various levels of affordability. In closing, We acknowledge the potential challenges LTC rate increases can present to our policyholders and to the administration in its role as an insurance regulator charged with balancing consumer impacts and the financial parameters needed to support a healthy and sustainable insurance market. And we are committed to serving our customers as effectively as possible by continuing to monitor and manage the financial profile of these blocks of business, by offering various options to our customers to manage affordability, and by providing quality service during the life of the policy, including most importantly at the time of claim. Thank you again, and Jake and I would be happy to answer any questions you may have.
Thank you very much. Could you please clarify if the rate increase requests are flat across the policy, or are you varying it by various benefit characteristics?
I can take that, John. Name is Jake Lucas. On all three of these filings, it varies by inflation type, with the larger increases on the compound uncapped inflation. And most of the non-inflation does not have a rate increase. So it increases with the level of inflation coverage.
All right, great, thank you. And then a similar question for anybody with inflation coverage that drops their rider to save on premium. Will they keep the accumulated value, or do they have a choice, or will they lose it, or how will that work?
Our general thinking is that they would keep it. If they wanted to not do that, I think we'd give them that option as well. But generally, they would get what's been accrued and hang on to that.
All right, great, thank you. I think that's the only questions I had. Adam, is there anything that you wanted to ask about?
I'm okay, Brad. Thank you.
All right, thank you very much. Appreciate everybody's testimony this afternoon. With that, Craig, has anybody in the Zoom call asked to speak from the public?
I'm not seeing anyone, Brad.
All right, in that case, then I guess we can wrap up this third quarterly LTC hearing. As I stated earlier in the call, public comments will remain open. And so if anybody would want to make any comments, they can go to our Maryland website, and we are accepting comments for one more week. And then we will publish all public comments, and we will, perform our review of these rate filings, and eventually make our determinations. And those will also be published on the public website. So I thank everybody for attending today. Thanks carriers for their testimony. And we can bring this hearing to an end. Thank you.